All right, let's talk about a powerful tool for your financial toolbox, the annuity trust. I know, it sounds a little complicated, but stick with me. We're going to break down exactly how it works step by step.
You know, this question really gets to the heart of it all. Whether you're planning for retirement, trying to support a family member, or just want some peace of mind, the big challenge is always the same. How do you make sure there's steady money coming in that you can absolutely count on?
And that's where the annuity trust comes in. Think of it less like a product you buy off a shelf and more like a strategy, a specific game plan you create to build that future income stream we were just talking about.
So, what is an annuity trust really? Well, at its core, it's a legal setup with a pretty simple goal. You, the person creating it, they call you the grantor, put assets into the trust. Then, that trust is designed to pay out a predictable income to whomever you choose, the beneficiary.
Here's a great way to picture it. It's like a protected automatic allowance. You put the money in, and a professional manager, the trustee, makes sure the payments go out on time, exactly like you wanted. No fuss.
So how does this whole thing actually work? Well, it's basically a three-step dance. First, you fund the trust. Second, the trustee takes over, managing and investing those assets. And third, the beneficiary gets paid. It's a really simple flow that's built for consistency.
Okay, now before you even think about setting one of these up, there's a huge decision you have to make right at the start, and it changes everything, from how much control you have to your tax situation. You've got to choose, is this going to be a revocable trust or an irrevocable one?
And this chart lays out the big trade-offs perfectly. With a revocable trust, you're still in the driver's seat. You can make changes, but for tax purposes, it's not really a separate thing. With an irrevocable trust, you give up that control, but it becomes its own separate entity in the eyes of the IRS. So the choice really boils down to one question. What's more important to you, flexibility or potential tax benefits?
All right, so once you've made that big decision, you can start looking at the details. Annuity trusts come in a few different flavors, and each one is designed for a different goal. Let's do a quick run-through of the main types.
First up, you've got the immediate annuity trust. This is exactly what it sounds like. It's perfect when someone needs income to start flowing right now, maybe to cover living expenses. You put the money in, and the payments start. Simple as that.
Then, there's the deferred annuity trust. Now, this is the ultimate long-term planning tool. You fund it today, but you set the payments to begin way down the road. It's a great way to plan for your own retirement, or maybe cover a grandchild's college costs in the future.
Now this one is really cool. It's a genuine win-win situation. A charitable remainder annuity trust lets you support a cause you really care about while also creating an income stream for yourself or someone else. You get payments for a certain amount of time, and when that time's up, whatever's left goes to the charity you chose. And finally, there's the pooled income fund. You can think of this one like joining an investment club. Your money gets combined with other people's, creating this one giant pool. That gives the manager more clout to find better investments, which could mean higher returns for everybody involved. Okay, so we've gone through the what and the how. But what about the why? I mean, why bother setting one of these up in the first place? Let's dig into the real benefits. So the number one benefit is obvious, right? That's steady, predictable income. But it doesn't stop there. You've got these cool options for charitable giving and pooled investing. But pay close attention to this last point, because it's a big one. A trustee can strategically decide when a taxable event happens. That kind of control can be a game changer for long-term financial strategy.
All right, let's pause here for a second, because we need to talk about something really, really important. We're going to cover a question that trips a lot of people up, and it can turn into a huge headache if you're not careful. This is something you definitely need to know.
So here's a question we hear all the time. Say you already have an annuity, and now you're thinking, hey, I should put this into a trust for better planning. Sounds smart, right? But can you actually do it?
And the short answer is yes, you can. But, and trust me, this is a massive but, doing so can trigger a huge and often very surprising tax bill. You have to be so careful here.
So why does that happen? Well, it's all about how annuities grow, tax deferred. When you transfer the ownership to a trust, the IRS basically sees it as if you cash the whole thing out. And suddenly, all those years of gains that were growing without being taxed, boom, they become taxable income all in 1 year.
And that brings us to the golden rule here. The one thing you absolutely have to remember. To avoid this tax nightmare, the solution is actually pretty simple. The trust has to own the annuity from day one.
Planning ahead and setting it up right from the very beginning is the only way to avoid that massive financial headache.
So, at the end of the day, an annuity trust isn't just some legal document. It's a way to create control and predictability. It lets you write the script for how your assets provide support. But like we've seen, the biggest decisions, like revocable versus irrevocable, or who owns what from the start, have to be made with a lot of careful thought. And that leaves us with the real question. With the right planning, what kind of financial story do you want to write?